Well, hi again. Today I'm going to be talking about a couple of terms that we hear all the time. The other day, when I was driving, listening to the financial news in the car, I heard the announcer talking about how the markets are doing at that point in time. And for some people, it can be a little bit confusing. Sometimes, even for us, it could be a little bit confusing. But they were talking about the yield, and they made a big deal about how the yield was up or the yield was down. So today I'm going to be going back to the classroom and talking about bond yields that change all the time and those that don't. So we're going to be going to the whiteboard, put the information up there, and give you a little bit of a lesson in bonds. Now, I am not a bond expert, but this is going to be a high level, hopefully basic translation of or interpretation of what it means when bond prices or yields change and those that do on a daily basis. For today's example, I'm just going to stick with treasury bonds, those that are issued by the US government, basically a loan. They loan money out, you buy a bond, they pay you back over time at a certain interest rate. Now, with new treasury bonds, when they're newly issued, let's take, for example, you bought a 10-year treasury bond and it's paying 3% a year for 10 years. You know that you're going to get your 3% and you're going to get your money back after the 10 years is up. Pretty straightforward. That's a new issue. But what if you don't want to keep it the full 10 years and you want to sell it? Now you're in the secondary market. So if you were to sell that bond, what you would get for that may depend on what new bond, what the current rates are. In other words, if the Fed had raised rates in the interim since you bought yours, let's say the new ones are paying 5%. Well, now your 3% bond isn't worth as much, so you couldn't sell it for $10,000. You'd have to sell it at a discount. So that discounted price between the price that you have to sell it for and your 3% yield, your 3% interest rate would create a wider margin or a higher yield. That yield would go up because your price went down. Conversely, let's say you bought that bond and it was paying 3%, and now interest rates have gone down and the new bonds issued are paying 2%. Well, you could actually sell your bond at a premium for more than $10,000, and the difference between that price and what the interest being paid is would actually cause the yield, the difference, to go down. So when the yield goes down, that meant the price that was being sold on the secondary market went up. And when the yields go up, the price it's being sold, that price it's sold for on the secondary market has gone down. So keep in mind when you hear that yield is going up or yield is going down, we're talking about the spread or the difference between the price that was originally paid to what people are willing to pay now based on the interest rate that bond had been issued at. So that difference, that spread, could be larger or smaller. The yield could be up or the yield could be down. It's kind of a seesaw effect. So bond prices go down, the yield goes up. Bond prices go up, the yield goes down. So at least you know that when they're talking about yield, it doesn't have to do with the new bonds that are being issued that day. It has to do with what people are willing to pay based on the current conditions. And that means when the yield goes up, the price goes down from that original price that bond was purchased at.